Good afternoon, everyone. My name is Abhimanyu Arora. Thank you very much for taking out time this Thursday afternoon. We're just starting the webinar. We should start in another 120 seconds from now. I see a lot of people joining in. You know the topic, which is just showing on the screen. So please be on with the particular topic. He's the co-founder and CFO, and of course, a very big industry expert to talk about, Mr. Sameer Bhandari. Well, again, thank you everyone for taking out time this Thursday afternoon. Today is the episode 17 of our educational series, which we have been doing. And of course, everyone has known about the current event which happened politically, which is the union budget, which was declared 26-27. We just thought to decode a bit and, of course, to have a understanding from Sameer what it means and how it implies for our investors. Before I get on to that, I'll just talk a bit about the leadership team at HBITS. Mr. Shiv Parekh, who's our founder and CEO, he's actually a Citibank and Stanford management company. He's as an experience, MBA from Harvard, and of course, undergrad from BS in physics from Stanford. While we look at that particular portfolio, Mr. Sameer Bhandari, who joined us around 3.5 years back to accelerate growth at HBITS, he's in he's IM batch 1989. I'm batch 1989. And if I'm not mistaken, chartered account 1987. He joined 89 in Bank of America. He shuttled between Mumbai and Hong Kong till 96. In 96 to 99, he was with UBS Singapore as in managing director. In 1999, he moved to JP Morgan Bank, Singapore till 2008 June. In June 2008, he moved to Lehman Brothers. And we all know Lehman Brothers moved to Nomura. So he was there from 2008 till 2021. He was a co-head of sales globally. Sameer, when we talk about move further, I just as well want to understand that looking at the current market scenario, we are looking at great good amount of information from your end. If you before we go on to the budget part, since you are a part of you manage all assets and you sit in Singapore, if you could just talk about little geopolitical part and little something about what's happening around in terms to maybe interest rate, something about that.
Sure. Firstly, thank you, Abhimanyu, and good afternoon, everyone. Welcome to this webinar. What I'd like to do today in this webinar is obviously talk a bit about the global scenario, what's happening, what are the geopolitical risks, where do I see interest rates, where I see the U.S. equity markets, and then obviously the Indian equity markets, and then spend some time on the budget. The budget has obviously not impacted investors directly, except for one or two things. But just talk a bit about that, and then after that, talk a bit about wealth planning, right? How do you actually plan wealth? How do you increase wealth? Which I think is the most important thing. So let me dive in straight. So if I look at the global markets, they're obviously with Trump being there, there's obviously a lot of volatility. There have been tariff volatility, there have been geopolitical risk, and with Venezuela, there's a lot of tension with Iran, which is presently going on. So obviously, the geopolitical risks have definitely increased substantially. The Russia-Ukraine war is still going on. We had briefly had the India-Pakistan conflict, and so the world is becoming more of a tense place, I would say. And because of that, there is going to be a lot more volatility. So one thing I always tell investors is, please embrace volatility. Take advantage when there's volatility, when asset prices fall. This is when you actually take advantage, because long-term investors typically never really lose out as long as the assets they select are the right assets. Uh, so that's around geopolitical. Where I think the US economy is going, I think the US economy is reasonably strong. except for jobs, where people have been losing jobs. Otherwise, the economy is doing reasonably well. So if you see the earnings which have come out, 75% of the companies which have reported earnings so far have beaten their estimates, whether it's a revenue estimate or whether it's an earning per share estimate. So it's very, very clear that the companies in the US are doing well and the economy is doing reasonably well. What the dichotomy has been that if you see S&P 500, it's dominated by the so-called Mag 7 companies, the tech companies. It's almost 37%. The Mag 7 actually, though the results have been very good, have not been doing very well around the stock prices, whereas the rest of the 493 companies have actually started doing very well. So overall, the health of the economy is extremely good. Come pharma companies, financial companies, tech companies, pretty much across the board, companies are doing quite well. Um, Inflation is under control in the US. As we saw, inflation, which had gone all the way up to 9.9%, today is at 2.7, 2.8%. Um, Obviously, jobs are a bit of a concern. Plus, we're going to have the Fed chairman changing in May. So, what do I really expect on interest rates in the US? My expectation is uh, the US will cut interest rates by at least 75 basis points. So I expect the Fed funds to go to around 3.25%. So 75 basis point cut from here. I do think the cuts will probably start happening after Powell leaves. Though if the jobs data is really bad, then you might actually see them cutting even earlier. But 75 basis points, I'm very confident, is a given, which obviously then will percolate down to other countries also. India, I do expect, though they kept the rates on hold, I do expect India to cut at least twice this year. So I would say around 50 basis points. In terms of the equity markets in the US, I feel the S&P 500 uh, should go up 7 to 8% this year. I don't think it will have that double digit growth of and last few years been 20 plus, but definitely 7 to 8% dollar returns in S&P I do expect. India, I think India has been a laggard, and the FIs have been dumping, but the DIs, the domestic institutions, have been buying. So now in fact the domestic institutions volume is now just exceeded that of the FIs. Uh, I do feel the FIs will come back. I think it's just a matter of time, couple of months time. So next year, next year when I say is April 1, which is the financial year, and March financial year into April, I think next year returns in Indian equities, I feel will be double digits. So I do feel you will see returns of upwards of 10 to 12%, if not closer to 15. So reasonably bullish. I think companies are doing reasonably well, and the valuations now are definitely realistic. So let me just stop there and over to you, Abhimanyu.
Sure. And let's go come, to the topic of our webinar on the budgets. So if you can just cover a bit on how the global market economic factors impact this Union budget, and of course, following to that.
Of course, thank you. So obviously, we've seen tariffs which have had a huge impact on India, and especially the US-India stress or tension has been there. And because of that, I think it's pushing India to rethink its overall strategy, rethink export, and become more and more of a domestic kind of economy. The whole manufacturing strategy to basically concentrate locally. So the budget response, if you see, is 12.2 trillion rupees has been allocated towards infrastructure development. As we all know, infrastructure development creates not only a strong economy, it also creates a lot of jobs. So that's one of the main reasons it's done. there's a strong push for manufacturing self-reliance, and I think the tariffs really have pushed this, and that's why the government really wants us to have self-reliance manufacturing. Uh, the India EU free trade discussions have, as you see, has been very, very good. The budget response has been a transformative impact expected for labor intensive sectors such as textiles and manufacturing exports. So overall, like if you look at what India is thinking around the budget, it's really thinking about long term economic growth, right? It's nothing to do with short term that you help someone. What this government has done is they are now thinking 3, 5, 10 years down the road. And that's why the budget has not had a massive impact on the individual. But I think over time, this budget will have a huge impact on the overall Indian economy. Next slide, please. So the key economic snapshot, I just thought I'll go through that. The fiscal deficit target is 4.3%. Uh, the debt to GDP is now 55.6%. It's been reasonably in control. Uh, they're committing 75,000 crores per city economic region over 5 years. There's a lot of focus on cities with populations of 5 lakh plus. Obviously, there are investments which will go on in infrastructure, which I mentioned. So, connectivity, housing, utilities, you definitely will have investment coming in. There'll be, and very interestingly, they've created a dedicated REIT for some of these assets like railways, ports, power infrastructure, telecom. So this then allows retail to actually invest in a lot of these assets. And as these assets, as the country does well, you actually benefit by investing in these assets. So effectively, overall, if you see, is a big infrastructure push, and hence we feel that the property sector will continue to be robust, and over time, the tier one and tier two city markets will actually do extremely well. Next slide, please. So coming back, what is the budget really doing for investors? Obviously, it's rewarding patient investors, right? Infrastructure development, when you have uh, long-term investors, generally tend to benefit. So obviously, for the individual, there have been no changes in income tax slab, so it's maintained status quo for salaried individuals. There's no change in long-term capital gain tax also. Now, buybacks for promoters will be taxed as capital gain for all the shareholders. So promoters will pay an additional buyback tax, and non-corporate promoters may also see effective tax up to almost 30%. Um, and I think what the government is now learning from the Western world is that it should continuously provide liquidity for financial instruments. And we've seen in some of the corporate bonds, the liquidity is not as good. And by introducing, making sure that there's a market making framework, the corporate bonds liquidity will also improve. In fact, we've been thinking that when we have a SM REIT IPO, we want to make sure that there are market makers who will actually provide liquidity to our schemes also. The one I wouldn't say negative, but one thing which the government has done is increase the security transaction tax. Now, why has it actually done it? If you see retail obviously participates a lot in F&O, and 99% of the people actually lose money when they actually trade. And this is not only in India, this is also in the US, where almost a very large portion of retail actually loses money. So, this in a way discourages retail in a way. And what the government is trying to do is trying to protect the small investor as much as possible. So initially, if you see when this was announced, actually the stock market had fallen quite a bit that day. But it's really to protect the retail guy, the small guy, who's actually losing a lot of money. Next slide, please. So why don't I pass this to Abhimanyu? He'll talk a bit about different fixed income instruments. How do they compare? And we've also added a column on SM REITs to see how this will compare to fixed deposits, bonds, and debt mutual funds. Over to you, Abhimanyu.
Thank you, Samir. While we see there is a comparison between SM REITs, FDs, bonds, debt mutual funds, let's talk about average yields. 8% paid out quarterly, which is generally going to be rental, is going to be tax free. And if you look at FDs, it's 6 to 7%, bonds around 7 to 8%, and debt mutual fund is around 6 to 9%. Liquidity is very, if you look at in all the categories, it's either moderate or high. So it's actually same in all the categories. The main point which we want to talk about, or I want to emphasize more, is the taxation, wherein SM REITs come under rental tax free. Largely, maybe because we're doing a kind of a rental income based on the return of capital, and we can talk on further in this call. FDs are fully taxable, bonds tax based on type, and of course, debt mutual funds as per STCG or LTCG. The regulation, each and every instrument is under a framework of some regulation, SEBI, RBI. Market risk low, and if you look at in each the category, if you look at debt mutual fund, that's the only one which is from moderate to high. Investment value, which we see for SM REITs, is around 10 lakhs, FDs around 1,000, bonds around 10,000, debt mutuals around 500. Transparency is approximately high in terms to SM REITs. It actually depends on each and every parameter, which we have to do a proper due diligence and audit. So it has to be very clean and clear. FDs is medium, depends on the issue for the bonds, and it's NAV based for the debt mutual funds. Now, I'll just call in Samir again. We've talked much on the budget, we've talked on the global market, we've talked about different scenarios. But I just want to just talk a bit, ask Samir to talk a bit on how a customer on different stages can do his or her wealth creation stages with strategies as per the age.
Thank you, Abhimanyu. So this is just the different stages in wealth creation. I won't go through it detail, but you have basically accumulation, where you accumulate wealth. Goal-based planning. Here you have certain targets. You want to make sure that you plan well so that you can fulfill these targets. And these targets could be, it could be an education target for your kids, or it could be buying a home for yourself or looking after your parents. So you can have different types of goals, right? And every goal obviously requires planning. Then passive income creation. I think this is extremely important because as you grow older, you want to make sure that the income you keep generating the income without actively trading. So this actually becomes extremely important. And from there, you move to retirement, right? As and when you want to retire, you should have enough retirement corpus to make sure that when you live till 90 or 95, and you say retire at 65 or 68, you have that much income for 25 years so that you don't need to run around and you can have a comfortable life. Obviously, wealth preservation then becomes extremely important because you now are not earning anything. So your wealth, which you have created in the past, is actually going to give you that income which you need for the next 25, 30 years. And finally, it's the legacy transfer. I mean, whatever wealth you've created, you want to make sure that when you pass away, it goes very smoothly to whoever you want as your successor. So legacy transfer planning is extremely, extremely important. So these are, I would say, the different wealth creation stages. And in the next slide, I'm going to talk about how you should actually allocate your capital. And though it's very simple, there's no rocket science to it. But this is what I would suggest based on where you are in your life. I mean, in your age group, this is how you should try to do. It doesn't have to be to the T, but I think this definitely will go a long way in creating a lot of wealth for you. So if you're young, as you are building a foundation, you should have larger risk appetite. So equity should be 85 to 90%. Fixed income should be a very small portion, 10 to 15%. Uh, in fact, I've seen people who go as high as even 100% in equity. And when I talk about equity, I actually talk about slightly higher risk, basically higher risk assets, right? It can be equity, it can be sometimes commodity, or you may want to dabble in Bitcoin, right? And why not? It's a risky asset class, but you're young and you're building your foundation, so it's fine. You can take risk. Now, as you move on to the 40s and between say 40 and 50, obviously your risk taking appetite should slightly come down because you're trying to obviously create wealth. You have to send your kids to higher education. You need to spend a lot of money there. So my I would say 70 to 75%. I would say more like 70% equity, and rest I would say should be in fixed income. And when I mean fixed income, it can be any asset which gives you income on a regular basis. That's what I mean. It can be a fixed deposit. It can be a REIT. It can be a SM REIT. It can be a mutual debt fund. It could be anything. But that's what I would say. Um, as you become slightly older and you're moving towards retiring, or you obviously have made a reasonable amount of money, but you obviously know that at a certain time, 60 or 65, whatever that age is, you will retire and you will then need money for living without any salary income or anything else coming in. So that's where I would say the equity portion comes down. It's more like 50%, and the fixed income or the portion which gives you a steady income should go up 40 to 50%, I would say. And finally, as you go towards retirement, uh, and I would say your fixed income portion should be closer to 70, and your risk appetite obviously will be much lower. So your equity or equity like assets would become more like 30 to 40. Now, to summarize, this is not sacrosanct. This is what I think should be the asset allocation. Obviously, you can tweak the asset. Like for example, in equity, you could also add a bit of precious metals. You could also commodities. You could add Bitcoin. In fixed income, as I mentioned, it could be fixed deposit, can be REITs. It can be pretty much across the board. And of course, the percentages can actually move around. But I do feel if you can have the discipline and work towards it, creating wealth is not that difficult. And long-term compounding, if you can do, where you manage your money really, really well, that's what's going to create a lot of wealth for you. So thank you so much for this, and let's move now on to Q&A.
Yeah. So before that, Sami, we were talking about one thing, which was something called financial freedom, right?
Yes.
What do you think among these four stages one should reach? It could be, attained at any given point of time, but one should surely be looking at that particular front. You're used to that?
Yeah, so financial freedom effectively means that you don't have too much debt, or even if you have debt, you have enough assets to more than cover that. And you're not in a situation where you can be you may not have the money to live or whatever. So that's I think very, very important. And that typically will be around I mean, some people are lucky, so they might do it in the 40 to 50s, but definitely around the 50 to 60, definitely one should start planning. I would say in the 50s, I would say one should start planning.
Got it. Thank you. Well, this is a very, while you type in your questions, uh, I'll request you all to scan this particular QR and be a part of HBIT's community. All the updates are part of this channel community. It's a WhatsApp community. The recent news, what we do, even latest podcast which we did, with the managing director of JLL, with Mr. Shiv Parekh. You could see over there any update on any IPOs which you look forward to, or any particular information. Please be a part of HBITS community. While you're writing in questions, one more question to you, Samir. Since we're doing this webinar after like 3 weeks, there's been a solid discussion all about, and I'm sure people might be thinking, if you talk about global market, you talk about interest rate, you talk about financial freedom, you talk. Can you just enlighten us with the big two words for silver and gold? What's happening?
Sure.
Mhm.
So let me talk a bit about gold first. Obviously, gold is a commodity which stores value effectively, right? All the sovereign wealth funds, central banks own gold, and whenever there is stress in the system, i.e., where there's geopolitical risk, you will see gold as an asset class becoming very, very important. I think what's happened is with Trump coming in, the volatility has increased substantially. And I think it's not going to really come down till he's there, right? So I think gold, I mean, I would not be surprised if gold continues to perform really well. In fact, if you ask me, I would be long gold here for long term investors, not for speculation, for long term investors. I think gold will do extremely well. Silver, which had gone to a high of $120, now down to 82. It had gone down to 65 also. Again, longer term, because silver obviously has a lot of ways it can be actually used for solar and some of the other uses which it has. I do feel that these two asset classes will continue to do well. So my projection for silver by the end of 26, my guess is it's going to be closer to 140, 150. So I would say you could have 60, 70% return from here. Obviously, there'll be a lot of volatility. So you need to be able to stomach that. But if silver corrects a bit more, so it goes to 70, 75, I would personally be going long. So definitely I like both these precious metals now, and I think 26, 27 could be a very, very good year for precious metals.
Good. Now let's jump into the Q&As. Uh, and while I'm having this, so there are a lot of people who ask for the email address and the mobile number for us. Even in this QR code which we have mentioned over here, the information of that particular thing is available in the information of the community. To start off with, one question from Mr. Anil D is, what is the difference
Yes.
between SIF and SM REITs?
Sorry, what does SIF stand for?
Uh, Maybe it's
Right.
REITs and SM REITs. Maybe that's if I'm just think.
Maybe Anil can clarify.
Yeah, Mr. Anil, if you can just let us know what is SIF, which you're looking at. Uh, while you type in, just talking about another question which is there from Mr. Pranay Patel. Uh, is present pass through taxation mode in financial ownership? How is taxed in investor's hand? Maybe he's talking on the rental tax.
Yes. So presently, Pranay, the way we're going to structure it is we'll structure it as return of capital. So the IPO which will come, the income which will be paid quarterly to you, will effectively carry zero tax because it's going to be shown as return of capital.
Uh, this is a difference, I guess, some chat which is there, which I'll just. Question from Mr. Mukesh Takthani. What would be some of the advantages of investing in SM REITs versus REITs? I'll just take a question part by part. Uh, Second part two is, if you can throw some light on the taxation of SM REITs, the dividend income. And while we answer that, investing in REITs, like buying the stock from secondary market, how can one invest in SM REITs? Can you provide some names of existing SM REITs?
Sure, that's a great question. So there are five REITs which are listed on the exchange, Mukesh. SM REITs, there are so far only two listed. Now, what is the real difference between REITs and SM REITs? SM REITs typically will give you a higher income, so ROI will be much higher. SM REITs typically will give you anything between 7.5% and 8%, whereas REITs give you closer to 5.5%, 6%. REITs have mainly institutional investors in. So retail is a very, very small portion who are investing. Whereas in SM REITs, you have a lot more retail participation because SEBI clearly mentions that you need to have at least 200 investors in every SM REIT you list. So both are listed, REITs and SM REITs, both are listed. The ticket size in SM REITs, Mukesh, is higher. It's 10 lakhs versus in REITs, I think is 3,000 rupees or 1,000 rupees. So I would say these are the major, I would say, differences. Both are going to be listed on the exchange. SM REITs is also going to be listed. On taxation, as I mentioned, we will going to structure it as return of capital, so it's not going to be taxed in your hand. Only your capital continues to go down. So when you actually sell your units, the suppose and give you an example, you sell it after 5 years, you received say 40 rupees as return of capital, so your capital then becomes 60, and if you sell it at 120, the difference between 120 and 60 is what you'll pay capital gains on. um, how can one invest in SM REITs? When we launch an SM REIT, you can apply for the IPO, and if you don't get it in the IPO, you can always buy it secondary from the exchange. And provide some names of existing SM REITs. Yeah, one is Platina. Platina is listed on the exchange, which was done by PropShare.
Sure. Mr. Natarajan Sarwan said required contact. So my information is there on the community as mobile number is as well there. Please scan and have that particular information. A question from Priya Balani. SM REITs, can you explain on how it is rental tax free? Maybe, Samir, you can let us know how the return on capital with the full example maybe they're looking at.
Yeah, so as I mentioned, right, you've invested 100 rupees. You say get 8 rupees as rental income every year. Uh, After 3 years, say your property price is 120. Uh, you would have received 8 into 3, so 24 for 3 years. Your capital now would be considered as 100 minus 24, 76. So you will not pay any income on the rent or any tax on the rental you receive, but the difference between these two, what you sell, you will have to pay long-term capital gain of 12.5%.
Great. So I guess that's the information which we have. And of course, Samir, it's always a pleasure to have a webinar with you to understand and know about the global markets and your inputs in regards to how the markets are moving, the indexes. Uh, Great to always have you here. And thank you, everyone, to be a part of this webinar, taking on time this Thursday afternoon. We're looking forward for the next webinar in the month of course, in the coming month, but with different topics. And please continue to be a part of our WhatsApp channel as well as, and you will as well receive the recorded webinar in the link in the community itself. Thank you very much. Thank you, Samir.
Thank you so much. Thank you for
Thank
joining. Thank you.
you.